You don't want to sell the day before because you may not get what you think you're going to get.
Welcome to Alt Investing Made Easy, where we explore the complex world of alternative assets. I'm Roland, a securities attorney, investment advisor, and your co-host.
And I'm Sarah, an investment advisor and corporate attorney, and your other co-host. We'll guide you through real estate, private equity, and more, making complex topics accessible.
Tune in for insights that empower your financial journey.
Let's make alt investing easy, one episode at a time.
Welcome everyone to Alt Investing Made Easy. Today we're so pleased to be here with our wonderful colleague Dan Baucum. He's an attorney with FBFK Law, and he's here to talk to us about certain tax issues that I think everybody will find interesting. Welcome, Dan.
Hi, Sarah. Thank you for having me.
Yeah, thanks so much for being here with us today, Dan. We're really pleased that you're our FBFK colleague and partner, law partner. I just have to note that when I use your name with people around the state, particularly, probably nationally, you're a well-known expert in your field, and it's just a real privilege for us to be working with you. And so welcome to Alt Investing Made Easy, and we'll start out. Dan, tell us a little bit about your background.
Sure. Thanks, Roland, and thank you for the kind words. I started out practicing law here in Dallas and got an opportunity to go to Washington, D.C. and work as a special assistant to the IRS chief counsel there for a few years, and then went out in private practice in Washington for a number of years more. Decided to migrate back to Texas for personal reasons, family reasons, and I've been here ever since, and I've enjoyed being with FBFK Law and the great folks here. We have a dynamic business merger and acquisition practice and all things related to that. And so it's been fun, and thanks for joining us, Roland, Sarah. Appreciate it.
It's great to be with you.
Yeah, for sure. We really enjoyed everything that we've learned. It's just FBFK has a really deep practice, and all the attorneys here are just so well qualified, and it's causing us to up our game.
It's always good.
All of us.
Well, I guess let's start
Roland,
out this topic, it's tax intensive. And so I'm going to dust off my LLM in tax today. I don't practice tax law all the time, but Dan, you for sure do. And what we're talking about today is really that everybody's heard about the OBA Act, or the One Big Beautiful Bill Act, that was enacted recently and made changes in the tax law, some of them permanent, but some of these changes that were made permanent harken back to 2017, when there was a prior change in tax laws. And that's what we're really getting at today. We're talking about a couple things, but first, let's talk about this idea about LLCs as being the preferred choice of entity so frequently when we're dealing with startup companies and companies that are, early stage companies, thinking about how they're taxed. Maybe they're organized as an LLC, but as we know, the default classification for a multi-partner, multi-member LLC is a partnership, but an LLC also can elect to be taxed as a corporation, and even an S corporation. We could go on and talk about that, but let's stop at the election of C-Corp status. Dan, this is what we were talking about. That may be advisable in some instances, and we maybe have gotten habituated to just allowing the default classification to apply. So tell us a little bit about why the election to be taxed and have an LLC taxed as a C Corp, why that may.
Sure. Great lead in, Roland. You really hit the marks. And so, yes, I'm a partnership tax guy, and so I definitely like pass-through taxation. And I do believe LLCs are still the entity of choice, but they're not a blind choice. That is to say, you do have to do the math. You need to, when you're trying to choose between an LLC and a corporation for tax purposes. And unfortunately, taxes are the tail that wags the dog in a lot of instances, even in choice. And so you have to pay attention to what is happening. Is a corporation better? And what does that turn on? But before we do that, it's useful to think about what LLCs are good at and what corporations are good at, just to set the stage. Is that fair?
Yeah, for sure.
That sounds great.
And so to me, LLCs are the most flexible vehicle. You can, if it's an LLC taxed as a partnership, you can allocate income gain, loss, deductions in so many ways within reason. And so the economic rights are very flexible, and that's very useful in trying to create different interests of ownership, different economic interests of ownership. I can do that very easily with a limited liability company tax as a partnership. And by the same token, governance, that is to say, whether the LLC is governed more like a partnership where all the partners have an equal say, or more like a corporation where there's a director or a manager in the case of an LLC, or a board of directors in the case of a board of managers, you can have that flexibility of governance between the two types and still be in the LLC world. And so I think LLCs are great. Don't get me wrong. And if you look at the data, there's about 80% of the operating entities in the state of Texas, for example, are LLCs. Corporations come in second with 10 or 15%. And then the others, LPs and such, are also RANs, frankly. They're useful in context, right? And so if you get to the governance issues, that's great, but the tax issues are what we're here to talk about. And the flow-through aspects of taxes are useful in many instances. That is to say, you know what your tax rate is. It's the individuals or the owners, the members' tax rate. Plus, you can pass through all the deductions that you have for a startup company. But I will drop a footnote here and say, maybe you can, maybe you can't. And we ought to talk about that in a minute. And then, there was as you mentioned, these rules for the most part have been around since January 1, 2018. They were enacted in the Tax Cuts and Job Act of 2017 during the first Trump administration. And they've been around with us ever since. And so the tax rates and the rules have been here since then. And for the most part, the One Big Beautiful Bill extended and made permanent the tax rates for individuals as well as corporations, as we'll talk about in just a second, and extended other things and actually improved some other aspects of partnerships as well as corporations. So then you turn the page and think about corporations. What are corporations? Well, they're taxpayers themselves. The shareholders don't pay taxes in what's called a C corporation, that is an entity that's taxed as a taxpayer for federal tax purposes. There's an S corporation, and I'm not talking about those here today. But those are pass-through entities, and they have their purpose. But C corporations are what I'm focusing on. And so the corporate tax rate is 21%. It's a flat tax rate. It doesn't matter whether it's ordinary income, just sales income or whatever, or income from the sale of a capital asset, that is capital gains. It doesn't matter. 21% is the tax rate. And then the old saw of you don't want to be a C corporation because you can't get the money out. You pay the one tax at 21%, which is a very low tax rate, frankly, compared to individual tax rates. But how do you get the money out? Well, you can get it out by salary, and salaries can be pretty substantial. But if you have to pay it as dividends, you're going to pay a second tax at the individual level, which is taxed at the normal capital gains tax rates in most domestic corporations. And so you've got a double tax, and that's always been the thing that scared everybody away from corporations. And that actually relates back to pre-2018, when the tax rate for corporations were a high of 34% up to $10 million and 35% after $10 million of income. Then you had a double tax of 50%. Nowadays, if you do the math, the double tax is 39.8%, which is not all that different from 37%. Does that make sense? So they're two different animals.
That's a great way to put it, actually, Dan, to put it in perspective like that. I think it makes it more clear. Sorry, Roland.
And I guess then, I don't want to jump ahead, but there are good reasons to use corporations. So if we can equalize the tax effect, so to speak, as much as possible, then we step back and no longer allow the tax to wag the dog, the tax tail to wag the dog, so to speak. We can really look at the substance of the entity types, decide, well, how do we want to be taxed? Maybe speak to that, Dan. Why would we maybe prefer a corporation over a LLC or an entity taxed as a partnership?
Great question, and I'm glad you asked. So the big reason I think is I asked my clients, what do you want to do with the profits? Do you want to plow the profits back into the business, or do you need to distribute the profits to yourselves and your fellow owners? If the answer is I'm going to plow the profits back into the business, I need to grow my business, and I'll worry about getting out of the business later on, my increase in value. And corporations you really need to take a look at, because I can assure you that for all but the few instances where people don't have a large income themselves, 21% is a lower tax rate to pay on profits if you're going to reinvest them in the company, as opposed to paying up to 37% for a joint taxpayer's $700,000 or $800,000 worth of income. A lot of business owners have $700,000 or $800,000 worth of income. You're going to pay 37% and then plow the money back. Well, you're leaving a lot of money on the table, aren't you? So maybe in that instance, corporation makes some sense. Now, there's some downsides too, but I'm sure we'll talk about those.
Yeah,
Well, let's talk about that.
Yeah, sure. Yeah, what are the downsides?
Well, again, if you want to get the money out of the company at some point in time, or if you think your buyer base, if you're going to sell your company and your buyer base is going to want to buy assets as opposed to corporate stock, you may not want to be in a corporation unless you want to serially, that is to say, time after time after time, buy and sell businesses using that corporation shell as your holding company, because to get it out, you're going to pay 39.6%, in taxes at minimum, which is not a lot more than 37%, honestly. But you're going to pay that, right? Because you're going to sell the taxes, pay a corporate tax of 21%, and then get the money out as a dividend. Or as a redemption of stock in liquidation of the company, and that's going to get you up to 39.8%. Tax rate, double tax. If you can sell the stock, be a corporation's your key, because you've actually built the company up quicker with greater after tax income plowed back into the business.
Well, and aren't there some other advantages? There are certain circumstances where selling stock is also advantageous.
Yeah, and the one thing that people have been ignoring since 1993, and for good reason, frankly, until the early 2000s, is a thing called qualified small business stock. And that is, some people refer to it as Section 1202 stock. Qualified small business stock is something we really ought to pay attention to, particularly if you think you can sell your company and sell its stock, and you want to plow the money back into the business. Boy, what do you get when you actually qualify under Section 1202 as qualified small business stock? Well, you get to exclude capital gains taxes. You heard me right, exclude. That is to say, not pay taxes on the greater of $15 million today. It was $10 million for stock held prior to July 4th. Or 10 times the amount of money you invested in the company, whichever is greater. And so that can add up to over $3 million of money you did not pay taxes. That's $3 million of taxes you did not pay if you're able to take advantage of that. So maybe that's a game changer for some people that we ought to pay attention to. In fairness, 1202 qualified small business stock has been around for a long time, since 1993 earnest, and certainly since 2018, but it's just now catching on with private equity. And so private equity is actually buying qualified small business companies and putting it in their portfolios, because they want their investors to also be able to exclude those capital gains taxes. And oh, by the way, if you need a sweetener, if you have a family member or kids or grandkids, each one of them, if you do it right, you can gift some of the stock to them, and they each get their own exclusion of $15 million
Wow.
or 10 times the amount of money you invested in it. So you can really stack these exclusion amount and not pay much capital gains taxes in the right circumstances.
So,
Choice of entity
Dan, I
is
think
always.
sorry.
Yeah, no, go ahead, sir.
I was just going to say, maybe we could talk a little bit more, and maybe after Roland's finishes his thought, we could talk a little bit more about the 1202 qualifications, because it sounds really great, and it would be probably useful to understand some of the limitations on what it actually means, because I think I remember or recall that it needs to be the kind of business that's actually doing something. So, for example, manufacturing. And you had mentioned earlier that part of what the OBA does is support this policy that's supposed to support domestic manufacturing. So maybe we could dig down a little bit into that, of course, avoiding giving actual legal advice. And then, and just understand so people who are listening can understand that it's not a free deal over here. There are a lot of details to consider. Roland, sorry I don't know if you had something else to say.
No, that's a better question. What I was going to ask.
Well, good. You're right, Sarah. There's a lot of devil in the details. The Tax Cuts and Jobs Act in 2017 that became our tax law in 2018, was meant to encourage domestic manufacturing and domestic business in general, and that has carried on. Like I said, a lot of those provisions were scheduled to expire at the end of this year. They no longer expire. All the tax rates are the same. They're not going up, at least for a while, until Congress changes. And a lot of the deductions have been enhanced to some degree. And so one in particular added for domestic manufacturing that encourages domestic investment. So the tax law, generally speaking, is investor favorable. It's not as favorable for service businesses, arguably from a tax policy perspective, because service businesses are doing just fine in this country right now. And so maybe the enhancement isn't needed. And so this qualified small business stock under Section 1202 is generally speaking not available to people like you and me, lawyers, doctors, architects, investment brokers, things of that nature. If it's a service business or if you're in real estate or hotels or oil and gas, probably not available for you, even though we start thinking about non-service business investment types like oil and gas and things of that nature. But if you have high technology or trademarks, patents, things of that nature, maybe so. And even medical labs have been allowed to have qualified small business stock in some instances. Think of it as if an individual person is the reason that you are providing the business, that is to say, an individual lawyer or doctor. That's a good example of qualified small business stock under 1202 is not available for you. So that's one thing you need to keep in mind. There are others.
Yeah, just maybe at a high level, the requirements for the qualified small business treatment.
Sure. It has to be an entity taxed as a C corporation. It can't be an S corporation. It can't be a partnership. It has to be taxed as a C corporation. That's not to say you can't use limited liability companies. You can check the box under a limited liability company and be taxed as a C corporation. Perfectly fine for Section 1202 purposes. And in fact, if you have an LLC, you can, if done correctly, you can check the box and become a 1202 corporation. And so there's a lot of flexibility there to get to where you want to go. So don't think you have to set up a state law corporation to do this, but you do have to sell the stock or the membership interest in the corporation when you go to sell. You can't sell the assets and get 1202. There are strategies to deal with that. I mentioned one. If you're a serial entrepreneur, you may want to use the profits to plow it back into another 1202 company or things of that nature. So, you're enhancing your gain by not having, if you have to sell the assets, you can do that. You got to sell the stock if you're bailing out. Does that make sense?
Well, Yeah, and this is really, it should be noted that, you mentioned check the box election, and not everybody knows that if you could be operating as an LLC, taxed as a partnership for years and years, and then finally one day it makes sense for you to check the box and switch. And it doesn't mean you have to do any change to your organizational structure. It just changes your tax treatment. But that is something that it's a form that you send in. I'll test myself, Dan. It's a 8832, right?
That's right. That's right.
And so you send that in, and then afterwards you're taxed as a C Corp, even though you're still an LLC. So, this really is something that if any of our audience members have questions about this, get in touch with us, get in touch with Dan. We'll make sure that his contact information is in the show notes. And the tax savings here that we're talking about are huge. So this really could be a way for people to save on some taxes.
Yep. That's right. And so qualified small businesses does mean qualified small businesses. Up to July 4th of this year, the business had to be smaller than $50 million when it became a qualified small business. After that, the qualified small business ceiling was raised to $75 million. And so, but you don't have to stay qualified. You don't have to stay under $50 million. You have to be at the start $50 million or less, or $75 million or less today or less. You can grow to hundreds of millions of dollars and sell, and the rules still apply. You still exclude capital gains up to $15 million today, or 10 times the amount of money you put in it. So if you put $1.5 million or more than $1.5 million in the business to start it, let's say you put $3 million, it's going to be twice $15 million that's excluded. It's going to be $30 million that's excluded, because it's 10 times the amount of money you put in. Does that make sense?
Yeah, and
That's pretty incredible.
the 50 million and 75 million, that's a revenue measurement.
Yeah, it's a gross asset measurement, and there's some
Gross
rules
asset.
around how it's measured, but more or less gross assets. And you got to be careful about that. And this isn't an election, by the way. You either are or you are not. So if you've got a company that happens to be taxed as a C corporation and you're getting ready to sell it, maybe we ought to talk, because you may have qualified small business already, and you want to sell the stock rather than the assets, because you get to exclude the gain from the sale of the stock. And that is true for companies that were created in the early parts of this century or in the 90s. So let's talk. And so there's one other rule that we ought to mention, but I want to give you a second to ask me any questions you have.
Well, Sarah, what do you think? Do you have any?
I just think it's to reiterate for the audience that this is something that is hugely beneficial when it actually applies, and it's worth the analysis, is what we're discussing here. It's worth the analysis. That said, it's also worth getting expert advice, because it is a tricky area. It sounds like, Dan, there are a number of different aspects and directions that you need to consider, from how you value the business for the $50 million qualification or $75 million qualification point, to how you how you calculate any of the other calculations that are necessary. So I think it's one of those areas that, with tax law, tax advice, we can't reiterate enough, Roland, can we, to people who might be watching, that this is really worth the money you spend to get expert advice. You may save a huge amount, for one thing, but also you don't want to fall afoul if you think you have savings and fall afoul of that and then find out later that you miscalculated. This is a terrible situation to be in that also requires the services of people like Dan to help you sort out later. That's just a point I wanted to make.
Sure. And one final point I'd like to make sure your audience understands. There's no free lunch. You actually have to hold this stock for 5 years to get the full tax exclusion. And there's rules around that. Now, after July, there's a 50% benefit if you hold that stock for 3 years before you sell it, or a 75% benefit if you hold the stock for 4 years before you sell it. And you can get 100% if you hold it for greater than 5 years under the old rules, which applied up to July 4th and afterwards. And so it's real clear you need to understand when that business started and hold it for over 5 years to get the full benefit. And so you don't want to sell the day before because you may not get what you think you're going to get.
Wow. Yeah, that's a good point.
So
And it also makes sense, doesn't it? Sorry, go ahead, Roland.
Yeah, I mean, does it have to be a C-Corp for 5 years or just have to be? Okay.
Yep. It has to stay a qualified small business, which means it is an entity taxed as a C-Corp.
For that period.
I think that makes sense. Yeah, I mean, if the policy is promotion of domestic business and domestic, it's particularly on onshore domestic manufacturing and those types of businesses, then it makes sense that you need that 5-year window from a policy perspective.
It does.
It takes a while to build a business like that and stabilize it. So
usually it's not an impediment because it's going to take you 5 years for most businesses. But that said, that's one of the biggies. There's a lot more rules, and unfortunately, regulations have not been issued by the IRS in this area, and so there's not as much guidance as we would like. Hopefully, those will be coming at some point in the near future.
Well, Dan, as a partnership guy, you're going to appreciate this as well. There's another reason why I like C-Corps is when you're talking about equity compensation, it's so much simpler to issue stock options than it is profits interests.
It sure is. And I often, in my talks about this topic, that's one of the big benefits of a C-Corp. Not only just the stock options, which you can readily understand, and sometimes partnership benefits are a little bit more arcane, but very beneficial if done correctly. But not as easy as corporations. And corporations can do other stuff for their employees that C-Corps can't. I mean, that partnership.
Yeah.
Good point.
So,
glad you brought it up.
Dan, not to move on from a very technical topic, and that's what we're here to discuss today. But one thing that I would be interested to know, and this is something we like to do when we speak to our colleagues or really anybody that we interview, is just a little bit more about you. Like, what got you into tax law in the first place?
Besides being a nerd?
That's a standard answer from attorneys, so we need a little more than that.
A little more color. Well, I honestly have always gravitated toward, my father was an entrepreneur, and so I've always understood the economics. I enjoy economics as a discipline, but frankly, I didn't enjoy the math as much as some do. And so I went to business school and I was a combined accounting finance major, and I had a great professor at the SMU Cox School of Business by the name of Roland Porth, who's passed now. He taught taxes, and since tax was part of the accounting curriculum, I took every tax course there was. And then when I went to the SMU Law School later, at that time they had a cadre of really great tax lawyers and were well known for their masters of law and taxation. And so I took all of that as an undergraduate law, JD law person, and ended up working for a couple of years, and then went to NYU's law school for their LLM in tax, which I think is one of the best, if not the best, and has been for years in the country. And I'm very, very happy to have been allowed in. I was probably the last in the class to get in, but in any event, they let me in the door and they didn't kick me out. And so I got through that, came back to Dallas and practiced for a while, and then got a call one day to go up to Washington and work for the head of pass-throughs and special industries in the Irish Chief Counsel's office. And that was an eye-opener. And then I followed the acting chief counsel out to practice in D.C. for a while, and that was great. So I got hooked early, and
it sounds like it.
A little late to change now.
Well, Dan,
great.
One thing that I was talking to Roland about, just being your colleague and attending meetings that you run, it's just so wonderful. Every meeting that I've attended that you run, I feel like I come away knowing more and just having had a really pleasant experience and feeling like there's huge value for the time spent on that. And what's funny, Dan, is I realize that it's not just the meetings that you run, it's any meeting that you're in. You always have something that is so worthwhile to listen to, and you deliver it with such a, I don't know, wonderful approach that it's easy to understand, I suppose. And it's just every meeting that you're in, I come away with a smile. So I really appreciate that. It's one of those soft skills you have that I don't even know if it can be quantified, but I appreciate that. In addition to, of course, your vast expertise, which is such a wonderful thing to have in the background, knowing that you're there to rely on for easy or difficult situations or questions. So I'm really grateful to have you as a colleague.
Well, thank you. Thank you. I appreciate that. Well, I have taught for a lot of years. I taught at Georgetown Law when I was in DC for a while, and then taught at SMU for almost 17 years in their law programs, and Baylor a couple of times. And so one thing I learned early on, I better be prepared and be able to explain it in English. Otherwise, very, very smart young budding lawyers will take me apart, and they did more than one occasion. So I appreciate more than you know, Sarah. Those kind comments. Thank you.
Well, we talked a lot about the choice of entity type, and would you focus on any other areas of your practice, Dan? We were talking a little bit about the estate tax exclusion amount. Do you want to bring up any issues about that part of your practice?
Sure, I'd be happy to. The One Big Beautiful Bill Act also made permanent the gift and estate tax exclusion amount, which I think also is key for entrepreneurs. It's now permanent at $15 million starting next year per person. So you and your spouse could pass and pass $30 million worth of value to your heirs. It's $14.9 million per person this year. And so, the whole tax era, when I started practicing tax, it was the tax shelter era. I've been doing this for a while now. And nowadays, the tax shelters and all the flow throughs of losses have been severely limited, which is one thing that you need to model when you're choosing a pass-through entity, is to make sure you can actually use all those deductions, because they may be suspended because of passive loss rules and at-risk rules and tax basis in your partnership interests and stuff like that. And so I think my practice is holistic. I have had the great privilege to advise very well-to-do families, and I'm all the way to helping set up grandchildren's trusts now. When I start just doing those basic wills and hoping like all of us entrepreneurs do, that we're going to do okay. And so it's really magnificent to work through the years and do that. And I've been fortunate to work with people like yourselves, and we have a great estate and trust group here, and controversy trust litigation group and estate litigation group here that I get to have some input on occasionally, even though, it's the old saw, you find a lot of smart people and surround yourself, because you're not the best, you're not the shiniest apple in the bunch. So, and I've been fortunate with that.
Yeah, for sure. Whenever I'm in a room with you, I know, there's somebody smarter than me. So that's a good feeling.
No, about that, but as long as I got you fooled,
Well, that's great. Well, yeah, go ahead, sir.
Is there anything else you'd like to talk about in the OBO, or just anything else, Dan? I think we've got some great information and also some really specific information, and that's a wonderful combination for an episode. But anything else you'd really like to bring to our audience's attention?
No, not really. I think that the bottom line is there's not one right answer, and you need to do the work. You need to not fall into the old habit of I'm always going to be a pass-through entity, an LLC. Think about it. 9 times out of 10, it might be the right answer, but do the math. Have somebody walk through this with you, whether it's your CPA or your counsel, your legal counsel, and make a reasoned judgment before you pull the trigger.
My takeaway on this, Dan, when I talk to clients, I'm going to ask them your question: what are you going to do with the profits? And if you're reinvesting them, it may mean that you're going to be paying 21% instead of 37%.
Right. I think that's a key question, and I'm glad that that came through clearly.
Okay, well, I think that's a good place. What do you think, Sarah?
Yeah,
Wind up.
Yeah, let's do it. So
Okay.
thanks everyone for joining us today on Alt Investing Made Easy. And Dan, thank you for being here. You're welcome back anytime.
Thank you.
I'm sure there's always going to be something you can educate us about. So appreciate your time today.
Thank you.
And don't forget, everyone, take aim with your alternative investing strategies.
See you next time.